Hey everybody, my name is David Leslie and I am with Mutual of Omaha Mortgage. And what I wanted to share with you today is our new program, what we are calling the Lifestyle Home Loan. So here's what you're going to learn today. We're going to talk a little bit about what the Lifestyle Home Loan is and how you can purchase your dream home while still being able to preserve your retirement assets. So we're also going to talk about why you should consider using the Lifestyle Home Loan instead of paying cash or securing traditional financing. And I'm also going to go through and explain to you how the Lifestyle Home Loan works. So first of all, let me introduce myself, tell you a little bit about me. Now that up there is my mortgage license number. But more importantly, I'm a native Texan, and I'm also an Air Force veteran many years ago. But I've spent the last 25 plus years in the financial services industry. Primarily, I worked as a residential mortgage loan officer, but I've also worked and been licensed as a real estate agent, and also I worked as a financial planner, had a Series 7, Series 63 license in the past. So I'm familiar with retirement and financial planning, but that's not what I'm here to do. I'm here to represent Mutual of Omaha. In the last 5+ years, I've worked exclusively with baby boomers that are age 62 or better, and I've helped educate them on ways to use their housing wealth to preserve their assets, increase their cash flow, and ensure their liquidity. And you'll hear me refer to this as living the pie life, and that's just the acronym for preserve assets, increase cash flow, and ensure liquidity. So the big question that I have for you is, if you're not living in your dream home, then what's stopping you? So, question is home ownership different after retirement? A couple of other things we're going to talk about. What's different now than 20 years ago? If you grew up like me, you heard that your home and your investment in your home, that's your biggest investment for many people. But now as you get up where you're living on a fixed income, that home expense, that expense of where you're going to live, that becomes more of a liability. And home value growth isn't guaranteed. If we all remember back 2007, 2008, we do know that housing prices can decline. Now, paying cash for your home is what many people opt to do so that they can avoid a mortgage payment. But when you do that, you're tying up a substantial amount of money into the brick and mortar of your home, and it's unavailable. And when the market retracts like we're experiencing now, that might be somewhere you want to pull some of that money out that you can't really access easily. And again, monthly mortgage payments are very often a detriment to your cash flow, and being on a fixed income now, it's just kind of a double whammy, especially during bear markets, which we're starting to experience. So these are some of the ways that we're just talking about how home ownership is different. But is it still the American dream when you're retired? And I would say, of course it is. It's just whether it's an investment or an expense. How many of you want to age in place? Me too. Now this says a new ARP survey, a little bit old on this slide here, but that's from 2019. And 3 out of 4 adults who were age 50 or older wanted to stay in their homes and their communities as they age. You know where the grocery store is, medical doctors, church, friends, family. If you're not there yet, when you get over age 50, you start thinking about how can I be closer to the kids and how can I be closer to my community. So as we talk about this and we talk about housing today in today's market with increasing prices and things, let's talk a little bit about the housing paradigm as it relates to retirement. First option, and this is really an option when anybody buys a house, is you can pay cash. So using a purchase price of $450,000, if you pay cash, your total 5-year cash outlay is $450,000. Pretty simple math. There's some pros to that. There's no monthly mortgage payments, no compounding interest, and there's a possibility, and especially over the last few years we've seen that, of rapid home value appreciation. Now here are some cons. There's no liquidity. Again, that rapid home value appreciation, what does that really mean to you if you can't access some of that money? There's no guarantee that home value is going to grow either. And theoretically, again, go back to 2007, 2008, take a look at some people out in Florida, Nevada, some places like that. We didn't get hurt as bad here in Texas, but your home could actually be worth less than what it was when you purchased it. So another option, and more people over the age of 65 are actually involved with 30-year mortgages. So just took a look at that same $450,000 house, showed you putting 20% down. Again, that way you're not tapping all of your retirement resources. And again, this slide was a little old, and it showed a 3.3 rate, showed a loan amount of 360, and at a 3.3 rate, your principal and interest payment would be about $1,650 a month. Now, your total cash outlay, including your down payment, plus that monthly payment over 60 months, is $188,880. Now, I just put a little blurb up there to show a 5.5% rate with a little bit higher monthly payment, and now your out of pocket is $212,640. Again, that's a 5-year, looking at that over 5 years. So again, less money up front. That's a pro. It's a fixed payment, so you know that money's got to go out the door, so you can plan for that. And there's a possibility again of home value appreciation. Big selling point when you're younger and buying a house is that home value appreciation. But think again, how much value does that have for you? Unless you're planning maybe a couple of moves. Again, the cons we've talked about, the monthly mortgage payment, and if we did run into an upside down market, your state would be liable for paying off the mortgage debt, even if it exceeded the value of the house. So there's no guarantee of that home value appreciation. So what I want to talk to you today about is why you should learn about the lifestyle home loan. All it is a third option. We have the cash, we have the conventional or the traditional mortgage, you'll hear me refer to, and then you have the lifestyle home loan. So you're able to buy this dream home with about 55 to 60% down. So that's your out-of-pocket expense. And then there's not going to be a required monthly mortgage payment as long as you live in the house as your primary residence. Now, the little asterisk is telling you that you are responsible for paying the property taxes, the homeowner's insurance, HOA dues, and general upkeep of the house. And these are the same things you would pay if you owned your house free and clear by paying cash. So this chart, we can take a quick look at the chart. Look under the highlighted area where it says $450,000 purchase price. And you can see over there a 70-year-old would bring to closing about $247,000. Now, as rates change, that's going to impact the amount of money you bring to closing. But that's still pretty close to what it would be today. So, what are some other reasons we should talk about a lifestyle home loan? Well, we mentioned it first of all. How about no monthly mortgage payment? That interest anybody? How about, even though you're on a fixed income, you might be freeing up some money to invest? Of course, I'm going to tell you to contact your financial advisor. That's not what I do, but it's just an opportunity to maybe take advantage of that when you didn't think you could do that anymore. How about travel? Take one of those trips. You free up some money that you're not putting into the house as a cash, or you're not spending monthly on a mortgage payment, and you free up some travel money. Anybody have any hobbies? Maybe you like to play golf and you're not playing enough anymore. Here's an opportunity. Anybody have grandkids? I know that if you do, you certainly like to spoil them. It's a completely different experience. I have 5 grandkids of my own, so I understand. So here's my promise to you. We're going to talk about and give you more details on what the lifestyle home loan is, how you can qualify for the loan, and what type of property it can be used to purchase. So some questions that come up, we'll also go through a number of the frequently asked questions, and that is, can this property be sold? What type of people really own these, these properties? So here's the big problem that people have when they're considering a home purchase and they're retired or approaching retirement. You're not sure if you have enough equity in your existing home, if you sell it, to purchase your dream home. So everybody's been involved with the high appreciation that we've experienced in the Dallas-Fort Worth area, maybe where you've come from. And then you find out after talking to a realtor how much your home is worth. You go out to look at a new home and you see, I'm going to just take a sideways step. I can't really do anything better than where I am. This program might give you an opportunity to consider something different, as opposed to hesitating because you don't want to go into those other assets. You just want to use the money from the sale of the home. That's some people's situation. So again, with the lifestyle home loan, now you can buy that dream home and only use 55 to 60% of the purchase price as a down payment and still operate as a cash buyer in the sense that you don't have a monthly mortgage payment. Now again, you're not limited to the equity in your current home. You can use whatever assets you choose. It's just this allows you to possibly buy more home than you thought you could purchase before you knew about the program. So another problem is that you can't really buy the dream home, and this kind of goes together with the other situation we're talking about. You can find a home, but it's really only a sideways step. Maybe it's just a one story, but maybe the neighborhood's not really where you want to be. It's a little further out, away from the kids, away from your church, and it's just not where you want to go. Because you can't really afford to live in the house you really want. And again, with the lifestyle home loan, you're able to retain a larger portion of your cash and still live in the home of your dreams with all those options.
There's a way to have a payment, or to have your house and have more house than you ever dreamed of having with no payment.
The HECM allowed us to not only get into a new home in an area where we wanted to be, in a house that we wanted to be in, but it allowed us to free up money from the sale of the original house to buy a small condo for our daughter and grandson to be in.
Tell me about a HECM loan. And he said, my 62nd birthday, I'm going to go get in one. I'm from the school, if it sounds too good to be true, it usually is.
Was a bit miraculous that we were able to pull all of that off and still have money to decorate the house the way we wanted, and not have a mortgage as we headed into retirement.
Why do we want to put all of our money into a place to live and then have no money to enjoy whatever good mobile ambulatory years we have left?
First of all, we couldn't have afforded a place that nice without replenishing our savings.
The advice that I give to someone who's on the fence about HECM is nothing has gone differently than what we were told would happen.
It gave us the freedom to still be able to travel, have a nice home, not have to worry about as much financially. So it was like having your cake and eating it too. You can have a beautiful home and still travel and enjoy your retired years.
And we've got $63,000 in upgrades that I never would have thought about.
Because it was a life-changing thing for us.
And we did share it with other prospective buyers
Yes, we have.
too.
Yes, we have.
It's opened up a lot of opportunities for us.
We were able to get a really, really premium home with a lot of great upgrades. And we only had to take less than half of the cash that we had available to the closing, which we're going on a cruise next month. We're going to Palm Springs, California in March. We're going to the Masters in April. We're taking an Alaskan cruise in 2019. I mean, these are things that we would never been able to afford those things if we socked all of our money into a home. That's all we would have had was a home.
So here's a question that you may have. Dave, this sounds a lot like a reverse mortgage. And my question back to you is, have you ever heard of one? So If you're asking that question, that means yes, and if you haven't, it might have some negative connotations. But let me just talk a little bit about how this lifestyle home loan compares to a reverse mortgage. An FHA's term that you might hear for a reverse mortgage is a home equity conversion mortgage. So talking about the history of reverse mortgages, I just mentioned they became a part of FHA in the 1980s under the Reagan administration. Now in Texas, they haven't been around near as long. They didn't. The first ones in Texas were in 2001. They were approved in 1999 to go through some changes, and you've started seeing them in the early 2000s. So what if I wanted, back in the past, to buy a retirement home and use a reverse mortgage? And so what happened is people were paying cash for the house, closing on the house, and then turning around and taking a reverse mortgage and using the reverse mortgage to pull out the cash. Now that created the monthly payment. I mean, that eliminated the monthly payment, but it created two transactions because you had to close on the original cash transaction and then you had to close again on the reverse mortgage. And so there was two sets of closing costs involved. So under the Economic Recovery Act, a sister program was created in 2009. It wasn't authorized or approved in Texas until November of 2013. So this loan has only been available in Texas really since 2014, about 8 years, or going on 8 years. And it's a variation of reverse mortgage, and it works the same way on the back end, but it's the opposite on the front end. So let me show you what I mean by that kind of simply here. So on a traditional mortgage, everyone knows, what do? Let's just talk about a $100,000 mortgage. We take a mortgage out, we have a mortgage payment, we make those payments monthly. Most of the upfront cost is interest, even though the payment stays the same over the life of the loan. And over time, over 30 years, that mortgage balance is paid in full. And depending on the rates, you'll pay sometimes between 2 and 3 times that $100,000 to secure the house. And the graph looks a little like that. With the lifestyle home loan, it's just a little bit different. You're going to secure that same $100,000 mortgage. However, you're not going to be required to make a mortgage payment because the money's going to be added to the loan balance and the payment's going to be deferred until you no longer live in the house as your primary residence. So in that situation, that mortgage balance does go up over time. Again, though, you're going to enjoy living in your dream home without having to make a mortgage payment. So the question is, or the concern is, hey, that mortgage balance is going up. What happens when I sell the house and things like that come up? But the real question is, how many of you plan on buying your dream home and then moving? And if you do, there's certainly considerations, and we want to talk about that. But very often I hear the only way I'm moving is feet first out of this house. So if you're planning to live out the rest of your life in the house, this is a great, great option. Okay, so let's say I do move in 5 years though. And let's say the house sells for $500,000, and by the time I move, my balance is $280,000. What happens to that equity? It's yours, just like any other mortgage. When you go to sell the house and you pay off the lender, the remaining balance is yours. That's no different on this loan. So what if I move in 25 to 30 years? Well, that's going to be a time where the loan balance, and this is, the asterisk is saying it's using a 2.5% growth factor. But after about 25 to 30 years, you're probably going to be at a situation where the value of the house and the loan balance are about the same. The loan balance could even be higher. And in that situation, you just walk away from the house. It's no recourse. This is called the crossover point, but there's no recourse to you. So I'm going to go through a couple of quick slides here and just talk briefly about these items here. But what are the credit requirements? Well, FHA does require a financial assessment be done. And they are going to look at your history, your recent history, last 2-year history on paying your property taxes, homeowners insurance, HOA dues, and consumer debt. It's not a credit score driven program, and there are options on getting into the loan, even if you have some challenges in those areas. And that's a thing we can talk about one-on-one. There is some minimum income requirements as well. The FHA guideline here is FHA wants to be sure that you have the ability to pay your property taxes, homeowners insurance, and HOA dues, and have some extra money, they call it a residual amount, available to keep the lights on and keep food on the table. The minimum debt to income ratios, there's not really a debt to income ratio on this loan like there is on traditional financing. Very often someone who can't qualify for a conventional loan can qualify for, because of income, can qualify for this loan, because there's different ways that income is evaluated than on a traditional loan, and there's a much smaller requirement on the amount of income you need to have, because you're not making a mortgage payment. There's no monthly mortgage payment, and of course, I have to make sure I emphasize that you are responsible for your taxes, your insurance, and your HOA dues. Because very often in a mortgage payment, when you say that to many people, they think it includes the taxes and insurance. So be sure we're talking about the principal and interest payment. So how do I qualify? Well, a couple of rules. You and your spouse, if you're married, must be 62 or better. The home must be your primary residence. And the money that you use for closing, that down payment, 55 to 60%, that down payment, must come from an asset account, like a checking, savings, 401k, or it can come as a gift. So what type of property can you purchase? Well, a new or existing single-family residence. I talk a lot about new construction because many builders are excited about this program because it helps people get into, there's a number of 55 and older communities being built, and just living in a community like that changes a lot of lifestyles for people. They're popping up all over the metroplex. But it can be an existing home if you want to move next door or across the street from the kids. It can be a new or existing FHA approved condo. So there is a restriction on FHA, and I can help walk you through that, or walk the condominium process, condominium complex on how to go through that process. There is an FHA insured mortgage maximum claim amount of $970,800. So if you are looking in a price range that exceeds that, there's other options that we have, and we just do a comparison to see which one makes the most sense. The focus today is on the FHA insured loan though. So what could disqualify me? Well, there are a couple of things. Unresolved federal tax liens. It says federal liens, so it's really tax or other liens. And if you have that situation, we can talk through how to resolve them. If you've had a foreclosure or a pending foreclosure, like a short sale or a deed in lieu, in the last 3 years on an FHA, a VA, or a USDA mortgage, those are government insured programs. And so there's a requirement that you wait at least 3 years until that's been completed. You can't have a current FHA mortgage in your name. FHA only allows you to have one FHA loan at a time. So if you have an FHA loan on your current home, and maybe you want to keep it as a rental property, you would have to refinance that loan out of the FHA mortgage in order to do the new loan. So what are you responsible for? You've got to pay your property taxes, your homeowner's insurance, your HOA dues. You got to keep up the house, and you have to live in the home as your primary residence. So we're going to get into some frequently asked questions, and if you have some questions and you've been writing them down, I may answer some of them here, but if not, I'll be certain to answer them after we talk. But what if one person is 62 and the other is 68? And I don't know if you remember the charts, I kind of glossed over it, but the older you are, the less money you bring to closing. That's one of the factors. So if one of you is 62 and the other is 68, the age that's going to be used is the age of the youngest borrower. So what if one person is 62 and their spouse is 58? And those of you that have read about this program a little on the internet before you came, you might have heard that it's a term called non-borrowing spouse. Well, if you're going to stay in Texas, just have to get it out of your head, because in Texas, if you're married, both of you must be 62 or better, and both of you must be on the loan. And that's the state of Texas rule. That's different than other states.
Can I ask you a question, David? Like, why is that for this particularly, you both must be there? Because, like, for example, my husband and I just bought a house, but he's the only one on the mortgage. I'm not on it. So what makes this different that it has to be that way?
Well, the way that I understand Texas rules goes back to the Constitution and wanting your primary residence
Okay.
under the homestead laws to be protected.
Okay.
So under this program, there were ways where if someone was older and was on the loan by themselves and then they passed away, the other person could potentially lose the house because they might not have the ability to refinance the loan.
Okay, that makes sense.
Now, in recent years, that happened to people in other states and hurt them.
Right.
And FHA's made some changes over the years to the non-borrowing spouse to keep that from happening. But Texas just doesn't allow it.
Okay, makes sense.
And another thing people did was they would want to just put it under the 84-year-old's name instead of the 64-year-old.
Because they're paying different.
And they pay a lot less for that, and then this person is still potentially can lose the house. So what if one person is 62 and the other, who is not their spouse, is 58? So in that situation, if you're not married when you do a HECM loan, you can certainly the 62-year-old can certainly buy the house, put the title in their name, put the mortgage in their name. Anytime, though, that someone is over, 62 or older and not married, they just have to sign a disclosure that everybody understands that this loan does not pass on to the next person. The loan has to be paid when they're no longer living in the house. So who owns title to the home? And the borrowers are fully vested on the title of the home, just like any other mortgage. And as long as the taxes, insurance, HOA dues are kept current, primary residence is retained, the home can never be taken away, no matter what happens to the property values. Again, it's simply a lien on the property, just like a traditional mortgage. So what happens when we both pass away? And this comes up a lot, and it's a concern that you'll want to talk about. The house is going to be left to the estate and settled the same way as any other estate with a home or with real property. To be an executor, administrator of the estate will decide if the house will be sold outright or bought by a family member. There's going to be an appraisal done to determine the market value. And if the sales price exceeds the mortgage balance, then the difference is going to go to the estate. Here's the difference, though, and that is that the estate's not responsible for any deficit. So if we do find either the couple that passed away lived in the house for an extended period of time, or if property values plummet and the value of the house is actually less than the loan balance, then FHA is just going to take over the house. You're just going to give the house to FHA. You don't have to go through and sell it or do a short sale. Just give it to FHA. They're going to pay the lender the difference if the loan balance exceeds the market value. So the thing I like to think of in this situation is that the best case scenario is there's equity in the house. But at the very worst case scenario, you walk away with zero. Sometimes people care, but is this another way for the government, which means us ultimately, right, get themselves in trouble? And just like people to know, this is not a taxpayer funded program. It's not every person that does an FHA insured loan, whether it's a traditional or one of these, they're going to contribute to the FHA mortgage insurance fund. And that mortgage insurance fund is the part that keeps the investor whole in a situation where you're upside down. So in the case of an FHA insured loan on the traditional side, a part of your monthly payment goes towards your mortgage insurance. In the case of these loans, there is a small amount of mortgage insurance that's a 0.5 point a year that is added to the loan balance that pays that fee for these loans. So what are the closing costs? That's a common question as well. Closing costs are very similar to doing a normal FHA mortgage. There's 2% of the purchase price goes to FHA at closing, and that really goes to the FHA Mortgage Insurance Fund. It's called a mortgage insurance premium, and it's 2% of the purchase price. Same thing happens on a traditional FHA loan. It's just a lot of people, when they're retired, aren't getting an FHA loan on the traditional side. They're putting 20 or 30% down. But on a traditional FHA loan, upfront mortgage insurance premium is added to the loan balance for the same purpose. Now, the third-party closing costs, title, appraisal, recording fees, those are all going to still be applicable. And that matrix, which I have a book here that I can get to anybody and get you an online version of this. But when you see the matrix and you see the costs, when I'm talking about bringing 55 to 60% to closing, that includes the closing costs. So what if I'm building a new one? How does the financing work in this scenario? So many of you have probably built a home before, and you probably know after you go to the design center, you've got to give you have your earnest money, and then you go to the design center and you have some more money. Well, all of that in effect is a down payment, and it's the same as it is on this loan. Again, if you're putting 55 to 60% down, but you spend some money at the design center, put some earnest money down, that's all a part of that 55 to 60%. Now, if there are seller incentives, which builders do, not as much in the last year as they did before, those have to be treated as a reduction in sales price for this program. And I'm happy to work with your builder and make sure that we get the contract correct so that there's not any issues there. It's going to be the same benefit to you. We just have to put it in semantics to make FHA happy for the most part. How long does the loan process take? So if you're building a house, we're going to get you pre-approved so that you have a pre-approval letter for your builder. Now, when we do our pre-approvals, you're actually pre-approved by an underwriter. So we're going to be able to issue the builder a letter, a takeout letter, or a letter of commitment. Most of the traditional types of pre-approvals you get are just done through what's called a laptop pre-approval. So I'll walk you through that process. But the other thing I want to bring up, because it's just recently changed working with the builder, is now we're able to protect that principal limit. The principal limit is the loan amount. And so the loan amount less the sales price is what you bring to closing. Well, as rates rise, that principal limit goes down. So potentially you could bring more to closing 12 months from now if rates continue to rise. But we at Mutual of Omaha have just started a program where we can now protect that principal limit for 12 months. We just get you to do the pre-approval and do the application at the very start, or even if you're in the process of building a house and want to consider switching to this financing, we can protect you from that happening so that when we give you a principal limit and an amount to bring to closing, as long as the sales price doesn't change, you're going to be in the same place 12 months from now that you are today. And if rates improve over that 12 months, you'll be in a better place because you'll get the lower of the two. So who brings money to the closing table? Well, just like any loan, you're going to be covering the closing costs, that down payment. So what if I decide to sell my house in 10 years? The house is depreciated and I owe more than what I can sell for. And we talked about this from an estate point of view, but the house would be sold for the market value and the money is going to pay off the mortgage. And any deficits that's created is going to be paid by FHA to the lender. So what if I decide to move and I buy this house and I'm here 5 years and I decide I want to go live in the Villages in Florida. And so can I use this loan a second time?
I know someone that lives there.
Yeah, a lot of people live there. But if you decide to do that, you can absolutely use this loan a second time. You just would have to pay it off first by selling your house, and then you can use it on the new program. Again, you can't have two FHA loans at one time. So is the rate fixed or variable? And the answer is yes. It can be fixed or variable. sometimes people want to know, they think this program's too good to be true. So they say, how does the bank or the lender make any money? Well, on a traditional mortgage, the interest the bank charges is paid monthly to the servicer. On a lifestyle home loan, the interest is accruing on the loan balance. And so it's just deferred interest. Your loan balance is going to grow. And then when the loan comes due, you're no longer living in the house. That's when the lender gets paid. And again, we've talked about the mortgage insurance fund that protects the lender in the situation where the value of the house is less than the loan balance. He knows he's going to get his money. Very often I get this question, but does my existing home have anything to do with this transaction? Two separate things. The only way your existing home factors in is if that's where your equity is coming from for your down payment. We'd have to show when you sold the house, proof of those funds, because remember, we have to show where the funds come from for the down payment.
That brings a question from me. Okay.
Right.
So what are your options then if you are having to pull that equity from your existing house that you're selling? Obviously, you can't show proof of funds until the home has closed. So would you be forced to go into either could you use something like Orchard or Open Door, where they purchase your home and then let you stay in until you move? Or
Sure. Those two programs, yes, because they've purchased your home.
Okay.
So they've purchased your home, you have the proceeds, and now you can show that.
Okay.
For pre-approval purposes, let's say you're buying the house, you're building the new house, it's not going to close for 8 or 10 months. We'll pre-approve you based on you selling the house,
Okay.
if necessary. Sometimes some builders don't want that. They don't want a contingency like that.
Right.
And so if you have the assets, we'll pre-approve you with those. Maybe they're sitting in a 401k, you just don't want to use them.
Okay.
We can pre-approve you with that information,
Okay.
just with the understanding that's probably not where it's coming from.
So you may have to possibly do like a short-term lease somewhere, though, is what I'm hearing.
Yeah, I mean, that's
If-
going to depend on the person.
Okay.
Absolutely. Yes.
Okay.
However, I have had people also, because they have assets in other places,
Mm-hmm.
keep their house because maybe they want to do an estate sale at the house
Mm-hmm.
and they just want to be gone and have everything done and then maybe do some rework because they know they can get substantially more for the house if they do that.
I'm asking the questions I'm asking for my mother-in-law.
Okay.
Seriously. So I'm going to have more at the end, but
Okay.
and I'm asking because she has no assets other than
Her house.
Yeah.
Okay.
So
So she, in that situation,
okay.
she can't borrow the money.
Until she
So she-
closes on the house and
Yeah,
has the funds
but I mean, she
available.
can't borrow the money for the down payment.
Right. No. I'm
Yeah.
saying like she would have to wait till the existing home would sell to
Correct.
be able to show proof of funds for the new.
Now she could get a gift from a daughter, let's say.
A daughter that just bought a house.
Yeah.
Can't show that money anyway. But yes.
But gifts are available.
Which is nice.
That
Yeah.
helps.
Yeah, that does help. Okay.
So remember, we're going to kind of go through and recap here, but you're responsible to live in the home as your primary residence. You need to pay your property taxes, homeowners insurance, HOA dues, keep up with the home maintenance. And you and your heirs are not personally liable for this debt. And what I mean by that is it is a no recourse loan. So it's not going to come back. It's not going to show up on your credit report. Something that comes up is let's say your heirs want to keep the home instead of selling it. And you're in an upside down situation. So the loan balance exceeds the market value. So the example I give here is, let's say the loan is $200,000 and the house is only worth $100,000. FHA will allow you to sell that house for 95% of the appraised value. So in my scenario, $95,000,
Mm-hmm.
and use that to satisfy the $200,000 loan. So they
Okay.
do allow that to happen. And very often that's when someone wants to keep the home in the family.
Okay.
So the big question is, does anybody want to continue making a mortgage payment during your retirement years? And when you say no, but that might prevent them from living in their dream home. So cash, is that an option? Now you've tied it up. So again, we're going to go back to the pie, living the pie life. This is just a great option that allows you to own and live in your dream home. You keep the majority of your money outside of your house and working for you, which allows you to preserve your assets, increase your monthly cash flow, and ensure your liquidity. So something I always suggest to people is that a word of caution here. You'll hear this, you'll watch it, you think you understand it, and when you start to tell someone about it, you'll find out you really don't understand it as well as you thought. And just be careful about that, and please include me in your conversation. I want to be available for you to help you understand this program, but not for you to necessarily feel like you have to, explain it to everyone. If you have kids that you trust or a financial planner, I welcome the conversation where we all get involved and I explain the program. I do try to do seminars. I haven't been doing as many since COVID, but I welcome an opportunity to do these in the future, and I always welcome all of you to come and attend as many as you like.
And the one-on-ones can be done here at the Spotted Celebration. If anyone would like to meet with David here, we do extend that offer.
Absolutely. So what's the next step real quick? And we'll just kind of walk through these. If you are considering purchasing a house, whether it's an existing home, which will close in 30 days or so, or you're wanting to build a house, get together with me. I'll get you the information you need so that we can get a pre-approval letter out to you. And if you're just interested in taking a baby step and you want to just see what an estimated price range looks like, it says, I'll work with you on an amortization schedule, show you what it looks like, what you'd have to bring for your age, your sales price, your situation. And if you're working with a realtor, very often they're not familiar with this program. We at Mutual of Omaha do more of these loans than anybody in the country. And you'll hear them called a HECM for purchase or H for P. We just rebranded the name as a lifestyle home loan, but it's the same program, and we do them very well. The most important thing is that middle one there. Find the home of your dreams and contact me again to get a better estimate of what you'd need for a down payment based on your price range and the age of the youngest borrower. I will spend as much time with you as it takes. Too often I hear people say, I don't want to bother you, or I don't want to take your time. This is my job. I love doing this. I've been doing this now for over 5 years, and it literally changes lives. And I welcome the opportunity to be a part of this for you, whether it's just educating you and helping you understand, even if you decide it's not a fit for you. And if I don't think it's a fit for you, I'm going to speak up as well once I hear more about your situation.